What if every economic crisis you've ever heard of wasn't an accident? What if the collapses, recessions, and recoveries were all part of a cycle, one that benefits the same hidden network over and over again? And what if central banks aren't the firefighters they pretend to be during these crises, but the architects who built the system to burn on purpose? We're told that central banks exist to stabilize economies, to prevent chaos, control inflation, and protect our money. But what if their real purpose is far simpler and far darker? To turn every crisis into a permanent stream of interest. Forever. This is the story of how the guardians of the global economy quietly pulled off one of the greatest coups in modern history. A silent takeover of governments, markets, and even the concept of money itself. A coup built not with armies or force, but with credit rates and invisible contracts. This is the story of central banks' quiet coup. It all begins in the 17th century with the creation of the Bank of England in 1694. England had just come out of a costly war with France and needed money fast. But there was one problem. The treasury was empty. So a group of wealthy merchants made the king an offer. They would lend the government £1.2 million if they were allowed to form a private bank that could issue notes backed by that debt. The deal was accepted, and the Bank of England was born. From that moment, a dangerous precedent was set. Governments would no longer create their own money. They would borrow it from private institutions and pay interest on it. Debt became not a burden, but a business, and those who controlled the credit controlled the state. Over the next 2 centuries, this model spread across Europe and later across the Atlantic. In 1913, after years of backroom meetings and lobbying, the United States followed the same path. The Federal Reserve Act was signed into law, and the Federal Reserve System was created. It was presented as a safeguard against banking collapses. But what it really did was centralize monetary power in a private network of regional banks, with the authority to issue currency and set interest rates. From that day forward, America's money supply would no longer be directly managed by its elected government. It would be managed by bankers supposedly independent, but deeply tied to private financial interests. Then came the Great Depression. Markets collapsed, millions lost their savings, and confidence in the system crumbled. The Federal Reserve responded not by preventing the crisis, but by consolidating its influence. It became the ultimate lender of last resort, the one institution powerful enough to print money out of thin air and flood the system with liquidity. Every major crisis since has followed the same pattern. First comes the boom driven by cheap credit, then the inevitable bust, then the rescue led by the same central banks that fueled the bubble in the first place. Each rescue comes at a cost. New debt, new interest, and new dependence on the central bank's policies. The result is a self-reinforcing system where crisis isn't a failure. It's the business model. In 1971, the last barrier was removed. President Richard Nixon ended the gold standard, cutting the dollar free from any real backing. Money was no longer tied to gold or tangible value. It was now pure debt created and destroyed by the central bank's will. This single act transformed central banks into something beyond oversight. They could now print infinite money and use it to buy government bonds, corporate assets, or whatever they chose. The 1980s brought the rise of financial deregulation and global credit expansion. Interest rates became the heartbeat of entire economies. A small adjustment by a central bank could trigger recessions or rallies worldwide. Politicians learned that economic success no longer depended on productivity or innovation, but on keeping interest rates low and debt cheap. Then came 2008, the moment that exposed everything. The housing bubble burst, banks failed, and global markets froze. Central banks stepped in with a weapon few truly understood: quantitative easing. They created money digitally and used it to buy government and corporate debt. The world was told it was a temporary measure to save the economy, but temporary became permanent. By 2020, central banks owned trillions in assets and had injected more money into the system than ever before in history. So what happened to all that money? It didn't rebuild middle-class wealth. It didn't reduce inequality. It inflated stock prices, real estate, and corporate assets owned by the top 1%. The result was a silent wealth transfer on a global scale. Crisis after crisis, money flowed upward, and interest payments flowed back to the same institutions that created the problem. By 2025, the total global debt, public and private, has passed $310 trillion. Every new dollar created is born as a loan. Every loan comes with interest, and the more debt that exists, the more interest flows upward. That's how crises became income streams. Governments borrow to rescue markets. Markets rally on borrowed money. And when it all collapses, the central banks step in again, lending the funds to restart the cycle. Even the so-called fixes have failed. Raising interest rates to fight inflation slows economies and pushes governments deeper into debt. Lowering them reignites bubbles. It's a loop with no escape because the structure itself is built on perpetual borrowing. Debt is no longer a problem to solve. It's the product being sold. Now, the next stage is emerging. Central bank digital currencies. They're being marketed as modern solutions, faster, safer, transparent. But imagine a world where every transaction can be tracked, every account monitored, and every dollar programmed with conditions. A future where your access to money can be limited or switched off, based on rules written by the same unelected institutions that already control credit. It's not a theory. It's being tested in dozens of countries right now. The quiet coup that began with government debt is moving toward total digital control. Since 1971, the US dollar has lost over 85% of its purchasing power. The top 1% owns more wealth than the bottom half of humanity combined. And yet the world's financial system continues to expand on the same logic. Create crises, lend the solution, and charge interest on the cure. So what can we take away from this? First, central banks were never neutral referees. They were built from the start as instruments of debt control, turning government borrowing into private profit. Second, crises aren't just random events. They're built into the system to reset markets and reinforce dependency. And third, every new solution, whether it is quantitative easing or digital currencies, tightens the same loop of control. The warning is clear.